What we've seen, what most have seen, which is a rush to get a product to the shores because of the tariffs. We saw that in the first quarter through March. We're seeing it again now with the 90-day delay. And when we look at our diesel demand in particular, we can track it from LA to Chicago, and we're up across that corridor. So you can see product coming in and moving across the country. So we're starting to see that. The trucking companies generally are still in sort of a freight recession. So the big trucking companies are continuing to have to, sort of fight for freight and lower their costs. So the trucking industry is still in a tough spot. But by and large, we're seeing a ton of demand right now for fuel and other services.
That's really interesting, especially the LA to Chicago movement, because we talked to Gene Soroka from the ports of Los Angeles and Long Beach, and he was saying about 14% additional input coming through those ports.
That's right.
And he said it was a lot of pull forward. What comes on the other side of that?
Yeah, I think it depends somewhat, I do, on the resiliency of the consumer. And so you sort of blow inventory again to get ahead of things. Well, in order to kind of keep the free flow of product to the country, consumers have to now buy that off the shelves, so that begins to slow down. So it's sort of wait and see still to see how resilient the consumer is on the back half of the year, to see if that's going to unlock some more movement of freight across the country.
Yeah, there's been some speculation, some concern that we'd see shortages in some places. As you mentioned, we're in this 90-day pause period, reprieve from things. What's the talk that you hear? What's the scuttle?
Well, really around the reprieve, it's still ramping up. So we're just seeing more folks bringing things to the shore. Truckers are moving that product across the country. So diesel demand, so far the first half of the year has been very strong for us. We're actually up on diesel demand through the first quarter or so of the year. And the back half, I think, is where everyone's really worried on the back half of the year. Just it's sort of like the mouse inside the snake. What's on the other end? Right now you've got this glut of supply moving across the country. But what happens on the back end? But it's going to depend, I think, again, on the consumer, but I also think it's going to depend on what happens with the tariffs and what gets negotiated and then what gets unlocked.
What do you see from the strength of consumers? Because you sell a ton of coffee, too. Yeah. You've got other products where people are coming in and sitting down. What's happening?
Yeah, we see what most everybody else sees. They're under pressure, for sure. The C-store industry in particular, we've seen lower traffic. Typically, our products are priced at a premium because they're convenient. And we've seen convenience store prices rise about 3% and foot traffic's down about 4%. And so at Pilot, we're focused on bringing total value back to the consumer. How do we bundle more products and make more deals for customers? We did that with pizza here recently. We saw our pizza sales jump 12% month of March compared to month of March last year, which is really good. And then we've been able to keep our prices the last 18 months or so below the industry average for the first time in the last several years. Typically, we run a little bit hot compared to the industry, but we've been very focused on making sure we're bringing value back to the customer, keeping our prices
How'd you do
as flat
that?
as you can.
I'm assuming you didn't hurt your margins. How did you?
Margins are down a little bit,
Okay.
and that's okay for us. We really want to bring traffic back to our stores.
Okay.
Gas traffic for us has been down after COVID, and 44% of gas consumers at the pump go into the store. And with that being down, and then our value proposition being a little bit out of whack, we want to make sure we're bringing that back into line with what customers can afford, bringing them value, get them back in our stores. So we're remodeling our stores, as you know.
Yeah, you were working on cleanliness,
That's right.
working on remodeling.
That's right. And so we're seeing our stores go from a brand enhancing score, which is a basic measurement of how well we're meeting our guest basic needs. Are the bathrooms clean? Are the fuel islands cleaned? Are they being smiled at, greeted, and thanked? 30% of our stores were brand enhancing, 40% were brand attracting. We're now at 80% brand enhancing and under 10% brand attracting. So all the work we're doing on a total value proposition, from the shopping experience, how we're pricing our products and services, are starting to get us back in a very competitive spot with the market.
That's great. You guys had some big announcements just in terms of EV and charging stations. Where are you at this point?
Making a ton of progress. I think last year we were at like 30
Yeah.
stations that had chargers. We're now over 150. We're in 33 states now. We're on pace to get close to 300 this year, 500 by the end of 2026 is our goal. So it's going very, very well. And utilization is up. So at small numbers, but we're up 33% compared to last year on utilization, 3% to 4%.
I guess the question becomes, if you have an administration that doesn't support, whether it be consumer purchases of the EVs or maybe more importantly the infrastructure build out,
Right.
How does that slow the adoption process?
I think exactly that. I do think it slows the adoption process. EV vehicles do perform really, really well. They do. If you've ever driven in one, the technology is second to none. They have a great acceleration. sort of low drag, low friction, easy going. And so people do like them when they drive them. The challenge is the infrastructure to charge EVs. And so right now, the infrastructure for EV charging is rated very low. Anywhere from 15 to 25% of the EV chargers are offline at any given time. And so we know that in order to increase the adoption, we're going to have to get rid of that range anxiety. And so we're building our EV chargers that are really best in class. They have canopies, they have pull through instead of back in. They're in the front of the store, not the back of the lot. And we're seeing our plug score, which is a score that rates EV chargers. We're at 93%, and the rest of the industry is around 73% or so, 74%. So 7.4 versus 9.3. And so we're above the industry on that experience. And so because of that, I think we're starting to see more adoption for EVs and stopping at our travel centers, particularly on the weekends and the holidays. So I just think it's an unlock of the infrastructure. But like the NEVI grants, which help fund the projects, those being pulled back do slow down the infrastructure. But we have a great partnership right now with GM and EVgo. We're able to share in some of that capital risk. So we're somewhat insulated from it. And where the states are either pulling back on those grants or keeping them in place, this really reorders our progress of where we're going to go first. So we might have wanted to go to Indiana first, but there's something happening there, then we just go to Ohio first and then just reorder the flow of the work.
What have you done in terms of capex and the stuff that you're willing to commit? Did any of the volatility in the markets and in pricing affect any of your plans to this point?
Well, we're focused right now on reducing our debt at Pilot. So when I first took over, we had a little over $6 billion of debt. We're working that down. By the end of this year, we'll be close to $3 billion, so cutting that in half. And so that's really our big capital constraint internally, is paying off the debt. And then we've reordered our capital investment from new stores. And so instead of building new stores at 10 to 15 a clip, we're now building them at around 5 and reinvesting that capital in our store experience. So instead of doing 30 FEPs, facility enhancement projects, we're doing 60. We think we have this existing footprint of stores that are underutilized, and I think there's a ton of value in our existing footprint. And so we're investing our capital in our existing stores, pulling back on some ancillary companies that we had, the water business and some generator businesses that weren't really core to what we were doing, and reinvesting that capital in our store experience. So for us, it's pay down the debt, take care of the assets we currently have, maximize those before we go look to maybe expand our footprint even more.
Are you guys still doing any energy's futures trading? Is that completely done?
We do. So we carry a lot of fuel inventory. So typically you buy fuel, and the time you buy it, there's about a 20-day or so lag before you sell it. If it's coming over international, which we still do some international purchases, you have to come across the ocean, and there's risk, price risk, when you buy it to when you sell it. Same thing with the inventory we hold at our stores and in our terminals. And so we do some hedging, but that whole point of the hedging is to make sure we can be competitive at the pump. And so ideally, if you lose money on hedges, you're somewhat happy because the price of the pump is doing fine. And so it really is truly just a security of supply strategy for us, more than a financial speculation.
But you guys let go a lot of the people in that unit.
Yeah. We backed off the speculative trading. In other words, the trading that was just
trying to generate a profit.
Just speccing in the market. This is really, truly, let's make sure we can secure supply for our customers.